Okay, welcome to the lecture on lesson 1.3, how transactions change owner's equity in the accounting equation. Last lesson we kind of introduced transactions, but none of them changed owner's equity. All of these today will have some effect on the owner's equity account. So we're going to lesson objective 6, compare and contrast the types of transactions and increase and decrease owner's equity, and explain the difference between liabilities and expenses. Now, an increase in an equity resulting from the sale of goods or services is called a revenue. So anytime you increase your equity account because of a sale, that causes revenue to go up. So for example, we sold services to John Smith. That's a revenue. Okay? Now, a sale for which a payment will be received at a later date is called a sale on account. So when you see that sale on account, the customer is going to pay us, we're going to give them the stuff today, they're going to pay us at a future date. So January 10th, received cash from sales, $1,100. So what two accounts are affected? Well, we received cash because of a sale. So our cash account and our revenue, owner's equity revenue account. Okay, remember cash is an asset. The revenue account is an owner's equity. So here we have our cash. You see we don't have an actual revenue that we're putting in here. We're just for now putting it underneath of capital. So with this, we received cash from sales, received cash, so our cash goes up. We add 1,100. We go across the equal sign, so we have to do the same mathematical step. So we add $1,100, and we're going to put revenue in parentheses so we know why that capital was changed. Okay, so if we add to cash, we have a new balance of $1,935 and a new equity account, a new capital account balance of $3,100. And if we look at it, our equation would still be in balance. Then on January 12th, we sold services on account to Main Street Services, $500. So again, what two accounts? Well, we sold services on account. So because we sold the services, our revenue account is going to be affected. And we sold them on account, so we now have accounts receivable, Main Street Services. And you see that right up here, okay? So accounts receivable, Main Street Services is an asset. Again, if we have, for some reason, we need to collect that money, we have the right to go to Main Street Services and ask them for that cash so we can get our account up to date. So that's something we own. And technically, we can actually sell it to somebody else if we wanted to. Creditors do that all the time with certain bills. My mortgage no longer is in the same bank that I originally got it with. Another bank now controls it because they bought it from the first bank. Okay, so then the other account is revenue. Okay, and that revenue account is a capital account. It's an owner's equity account. So Main Street Services owes us more money, so we add $500, and our revenue goes up, or excuse me, $500, which indicates our capital goes up $500. And again, we're going to put revenue here to show that that account is a revenue account that's going to be affected. So our new balances, we have $1,935. We add 500 to zero is 500, 385 for supplies, 900 for prepaid insurance, 120 for accounts payable, Canadian office supply, and now $3,600 in our capital account. But if we add both sides together, we still should be an equal. Okay, so our total left side is $3,720, and our total right side is $3,720. So again, everything's in balance. Now, unlike a liability, which is the amount that is owed, the cost of goods or services used to operate a business is called expenses. Now, some expenses that you could have electric bill. Okay, you got to have electricity on in order to do work inside the building. That's an expense. Okay, Rent for that building is an expense. Employees that work for you, you have to pay them a salary. That salary is an expense. So here we paid cash for communications bill for cell phone and internet service, $880. So we paid cash, so cash is our first account. And right now, our cell phone bill and internet is just an expense, okay? Cash is an asset. Expense is an owner's equity account, okay? So when we analyze this transaction, we paid cash, so we decreased cash by $80. And because again, we go across the equal sign, we decrease our expenses by $80, okay? That gives us a new cash balance of $1,855. Services, Main Street Services is still $500. Supplies is $385. Prepaid insurance is $900. Accounts payable Canadian office supplies is $120. And now our capital has gone down to $3520. But if we look at our equation, we add up the left side, we get $3640. We add up the right side, we get $3640. So again, our equation is still in balance. Okay, now here we paid cash for an equipment rental, $400. Okay, cash is affected and expenses. Cash is an asset, expenses is a capital account, owner's equity account. We paid cash, so that's going to be decreased. We paid an expense, so that's going to decrease our capital account or owner's equity. So here we have minus $400 for cash, gives us a new balance of $1,455. And then we decreased our owner's equity, a new balance of $3,120. But again, if we add up the left side, we get $3,240. We add up the right, we get $3,240. So again, the two sides are still in balance. All right, this kind of gets a little tricky here. Now, with an expense, that is a direct relation to doing business. But sometimes the owner just decides to take some type of an asset out of the business for his or her own personal use. When that happens, it's not an expense because it had nothing to do with making money. It is a withdrawal. They're taking money out of the business. And I said it could be any asset. In here, it's pretty much going to be money, but an owner can decide to take a car out of personal assets. He can take some tools out for personal use, so forth. So on January 6th, we received cash on account from Main Street Services, $200. Now, if we look at this, we received cash. So cash is our first account. And from Main Street Services, so our accounts receivable, Main Street Services is affected. Cash is an asset. Accounts receivable, Main Street Services is an asset. You notice sales was not involved here. We've already recorded the sales because we had to do it at the time of the sale, okay? So if we look at our transactions, we increased our cash by $200. We decreased Main Street Services by $200. So that gives us a new balance of $1,655 and $300. Okay, but again, we stayed on the same side of the equal sign, so we have to have two different processes. We have to add and subtract. Again, we're just kind of converting one asset to another. So then we get down here, we paid cash to the owner for personal use. So Michael Delgado withdrew equity in the form of cash, $350. So what two accounts? Cash, because this is in the form of cash, and he withdrew, so it's our withdrawal account, $350. So here we have minus $350 from cash. We go across the equal sign, we got minus $350 capital, and we put withdrawal so we know why that happened, so we can differentiate between our expenses and withdrawals. So we have a new cash balance of $1,305. Accounts receivable, Main Street Services is $300. Supplies is $385. Prepaid insurance is $900. Our accounts payable is still $120. And our capital is now down to $2,770. But again, if we add them on the left, we get $2,890. We add them on the right, we get 2890. So our equation is still in balance. So if we look here on this sixth transaction, we received revenue in the form of cash, $1,100, so it increased our owner's equity by $1,100. Transaction 7, revenue on account, that increased owner's equity by $500. The 8th transaction, we paid an expense, so that decreased our owner's equity. On the 9th, we paid an expense for equipment rental, that decreased $400. And the 11th transaction, we withdrew equity $350. So over this period, that gives us a net change in owner's equity of $770. So in our lecture part, we will go through those types and we'll step you through how to do those on the forms.